Hello, this is Hank Cleare, and I'm a partner with Financial Strategies Group with offices in Weston, Florida and Atlanta, Georgia, and a proud member of Integrated Financial Group, a consortium of independent LPL advisors here to discuss turning a pot of money into a lifetime paycheck. An estimated 10,000 people are retiring every day, and this unprecedented surge of new retirees is expected to last for the next 17 years. Many, perhaps most, will roll their retirement plan assets into an IRA account. And that money, plus Social Security and any taxable investments they may have, will provide their living expenses for the rest of their lives. This is different from retirees in the past. Most often, they received a regular paycheck from their pension, their equivalent of a retirement paycheck. Many of the new retirees are required to make a new kind of calculation. How do you convert a lump sum retirement account into a sustainable income over the rest of my retirement? For those of us who are accustomed to receiving income throughout our lives from a paycheck, this is not an easy calculation to make. Suppose, for example, a 65-year-old couple retires, and when their retirement assets are rolled into an IRA, they have a total of $4 million between their IRA and other investment accounts. They can start receiving $1,750 a month from Social Security. With so much money in the bank, they're comfortable joining an expensive country club, traveling around the globe, and before long a large recreational vehicle is parked in their driveway. They even remodel the kitchen. By age 68, they still have $2.5 million in the bank, and they're spending $170 a year. Are they all right or not? This is the kind of calculation that financial planners or pursuit retirees wrestle with all day long. And there are some definitive answers. Some of the pioneering research into safe spending in retirement, most notably Bill Bingen of La Quinta, California, take into account what is called sequence risk, meaning some unlucky retirees will experience a severe market drop in their early years, which will make it likely that they'll run out of money before they die. The research assumes that the retired couple wants to raise their spending each year at exactly inflation rates, so they can maintain their spending power. Then it looks at historical market returns and identifies a spending level that would have survived even the worst sequence risk scenarios. The answer? Between 4 and 4.5% of the retirement portfolio in the first year, with the dollar amount rising with inflation each year. In our hypothetical retiree example, Social Security is paying about $21,000 of the couple's living expenses, meaning the portfolio has to come up with an additional $149,000 indexed to inflation for the next 30 years. That comes to almost 6% of the remaining portfolio. The couple feels financially secure, but they're at a high risk of running out of money if the market turns down in the next few years. Other research, notably John Guyton in Minneapolis, Minnesota, has factored in the possibility that maybe the couple would forego inflation increases in years when the retirement portfolio has lost money. This so-called adaptive withdrawal strategy allows a retired couple to maybe raise their spending to about 4.8% of the initial portfolio. Once again, under our scenario, our hypothetical couple is still in the danger zone. And this only covers 30 years. People who live longer would need to live on somewhat less. But how do you know? How long will you live? The Bureau of Labor Statistics researched actual spending of retirement, found the data and the assumption that people only increase at inflation rates was false. When they calculated the Consumer Price Index, it appears that they actually spend anywhere from 1 to 1.5% more than the CPI. If the CPI goes up 3%, actual spending may rise anywhere from 3.25% to 4.5%. Of course, all of the research focuses on surviving the worst-case scenario, the times when the markets are least favorable to a comfortable retirement. If the market climate is instead sunny during the early years of retirement, if our hypothetical couple happens to retire in a year of a bull market, then current spending won't be a problem, and they may actually be able to increase their lifestyle expenditures. The only way to know what may happen in your situation is to have a professional run the numbers every year in light of recent market activity and long-term guidelines, and help you chart a course through the income maze. Converting a portfolio into a paycheck is a surprisingly complex exercise. 10 years down the road, when a few million baby boomers are well into retirement, you may read about some of the simple, innocent, even tragic mistakes they made with their spending decisions when it felt as though they were flush with cash. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for individuals. Thank you for listening. This is Hank Cleare with Financial Strategies Group.